Good afternoon. Sorry for a few minutes. I was rushing back from my office after a quick discussion. Anyway, we are very much moving in the direction in terms of how we were looking at this subject area. And in fact, as I was repeatedly encouraging, please feel free to kind of raise any matters that you wanted to clarify. On top of that, you also can continue to follow materials in terms of not only the required reading highlighted in the course itself, but also in terms of publicly available information with respect to a subject area and also financial press. As I was repeatedly highlighting, financial press is a very important aspect of this program, because you will come to know not only the subject areas but also application, and application in the sense how best you can apply some of the knowledge that you have learned, but also understanding the discussions, more theoretical, if not more realistic and practical discussion with respect to the subjects you can follow up and discuss all throughout. So that's why I'm repeatedly encouraging your attention in terms of understanding the subject areas in terms of reading. So while that being said, you also can raise any queries by typing in the chat mode. And also from another perspective, you can also highlight your area of discussion in terms of unmuting your mics, and you can join the discussion. So we were discussing about the financial system, and we were clear in terms of how direct and indirect financial structures work. And then we also looked at debt and equity markets from a broader perspective, and also talked about primary and secondary markets. A primary market, you probably know the issue exists, where in most of government securities, as well as issuances of first time an instrument being issued, that is often refers to the primary market, where you also see lead arrangers, investment banks not only issue, but at times they underwrite. Underwrite means in the event of you are not successful in selling all the intended quantities, there is an underwriting arrangement where the arrangers would subscribe. That means they would buy either non-allocated lot, if not up to a cap, let's say 20%. If it is subscribed 90%, so the lead arrangers or the banks who arrange this issue, they will buy the balance 10. If it is 60% and their underwriting is only 20%, then they will buy that 20%. That means you will not be able to raise entire 100. You are ending up 60 plus 20, it's 80. So the primary market works in various ways, but we can get into more details as we move on. And the other aspect in the secondary market is you can see brokers and dealers work in secondary market, right? So they do not necessarily own and sell securities or government papers, bonds from their own portfolio, but they could sell from some other party. They act as intermediaries, right? So this is like you are, after purchasing in the primary market, all the transactions happen in the secondary market. So that's what this refers in from a broader sense. And then you see over the counters, you talked about this also. We know that OTC market, not necessarily something that popularly known, but in all the countries, all the financial markets, OTC are quite popular. Because of the OTC, you can avoid unnecessary volatilities in the market arising from big volume transactions coming into the screen-based initiations. So that's a very interesting aspect, because you see, even in the Sunday market, you probably see if a big volume transaction, big volume supply or big volume demand comes in, prices adjust. Prices adjust sharply. So in financial markets also, there is no difference, right? So that happens when the big volume transactions come to the market. At the same time, we also talked about money and capital market. Money and capital market, from a very straightforward perspective, you can separate it in terms of duration of the financial assets trade. If the financial assets trade are short term, which is money market, financial assets trade are medium to long term, that is capital market. So this is a very easy way of recognizing money and capital markets. In money market, you probably see financial assets of 1 year or less would trade, whereas in the capital market, the financial assets of 1 year or longer would trade. So the treasury bills usually trade in money market. Then you probably see all bonds and other financial assets which trades in capital market popularly. So there are other elements we can see here when it comes to understanding and recognizing a money market versus capital market. That is very, very interesting details here. You can see the duration. As we already discussed, the money market has a duration of 1 year or less. Okay, so here often short-term funds trade. People exchange short-term funds. And when it comes to capital market, you see it is the long-term funds where the assets of 1 year or longer trades. So that's a very straightforward recognition. And also nature of funds. Okay, here in the money market, often funding requirements or the requirements of participants are facilitating for working capital requirement. That is not necessarily a long-term fixed asset acquisition or expansion of your business activities. Like, no, in the money market, often you find elements of working capital requirements being looked at. And there may be circumstances, you see, one famously known example is in Sri Lanka. You probably know in Kandy, where the there is a city center is established. For that city center, some of the investments, as per details, being facilitated through overnight overdraft facilities. So that means every other day you have to renew your transaction. But for long-term investments like that, ideally it should not be a money market kind of arrangement. It should be a capital market financing arrangements. Okay, so you see the nature of funds trade in money market is often working capital facilitated, whereas in the capital market, supplies funds for fixed capital requirement. You wanted to expand your buildings, you want new machinery, you want long-term assets being purchased, right? Long-term training and development, research and development, laboratories, right? So most of the expansions takes place, and these are contributing to growth is capital market based funds. So you can get a kind of a feel on it. Then you see instruments. What instruments trade in money market? You see instruments are bills, commercial papers, CDs, that is certificate of deposits, overdrafts I was mentioning. So these are quite common in money market. On top of this, there may be transactions between money market participants itself. They have their own transactions arrangements. For instance, in Sri Lanka, the call money market. Over the phone, they know how much you want, how much the other party can extend. They give without any hesitation, but up to a limit. You have set your borrowing limits, your exposure limits. Party 1 wanted to lend to party B. Party 1 knows how much my cap with respect to lending to party B. So party B also knows how much I can borrow from party A without having any collateral, underlying assets being pledged. So there are instruments of that nature in money market. But when you go to capital market, you see shares, debentures, bonds, right? Fixed assets. These are the things that trades. Then you see also the amounts of instrument, right? And in money market, single instruments of large values trades, right? And in the capital market, large value instruments trade, but even small amount transactions trade. People, startups comes in, they assets being financed in capital market, small quantities, small amounts, and even first timers who wanted to feel the capital market, right? They come and buy and sell assets. So that's possible, but still you could see huge volumes of transactions happen in capital market. But mostly in money market, often the volumes are large because parties who engage in money market transactions are reasonably sophisticated investors. So you see this type of elements play a role in capital markets. And any questions? If you wanted to clarify anything, you can drop a message in the chat mode, or you can raise by unmuting the microphones. So that would help not only you, but others also to understand some of the concepts that we are discussing. And then you see institutions. Institutions come and play a role in money markets. You see central banks there. Central banks not only buy financial assets, but also sell financial assets. You probably see their open market operations. They buy and sell government securities. Thereby, they adjust the overall liquidity level in the market. And the commercial banks play a big role in money market. I said call money market. Often the call money market participants are licensed commercial banks. Then, of course, acceptance of houses, non-bank financial acceptance houses. There are things. Acceptance houses are registered parties to transactions. There are registered parties to transactions. We probably not necessarily see that type of institution in Sri Lanka, but in advanced economies, OECD countries, it's reasonably common. Then you see NBFIs, non-bank financial institutions, the brokers. These type of participants are very common in money market. Then in the capital market, often established markets, stock exchanges, bond exchanges, commodity exchanges. These are marketplaces. Not only they are markets, but also they are facilitating others to exchange financial assets on their platforms. They have live trading desks. So anybody wants to sell, they can upload their selling volumes with expected prices. Anybody wants to buy, they could also follow suit. So when transactions shapes up, naturally transactions get cleared. If somebody is willing to buy, somebody is willing to sell, the prices match, transactions clears. Nobody knows who bought mine, right? It's a very special feature in exchanges. And then of course the commercial banks and non-bank institutions exist as money market, and then also insurance companies, mortgage bank, building societies, pension funds. These are long-term institutions, long-term asset buying institutions. They play a very good role in capital markets. Then you see the risks. In the money market, risk is relatively smaller because the duration of assets that you buy is short term. Okay, and in short term, anything could happen is comparatively, probability of things happening is lower. And whereas in the capital market, you look at longer duration, 30 years, sometimes 60 years, sometimes the perpetuality. There is no defined maturity horizon. Anything could happen, right? So the probability is long in terms of longer durations. The probability of uncertainty, anything happen, is greater in capital markets. So capital market instruments, because of that reason, carries a higher interest rate. Not necessarily all the time, but generally under normal market circumstances, it carries a higher interest rate, right? So you see this type of things, and then you see the transactions, okay? And money market transactions are often phone-based, and there is no particular formal place like exchanges. It could be on the basis of your own institution's arrangements. And in the capital market, often you have exchanges, formal places, and the transactions are followed in terms of established processes and established arrangements, rules, regulations, documentations, things like that. In the money market too, there are documentations, rules, regulations, all there, but reasonably less when compared to capital market transactions. And then the brokers, transactions without help of broker happens often in money market. The parties to the transactions, who has more assets, resources, who has surpluses, and the institution who has a borrowing requirement, they meet each other over the phone. They know each other. They are established participants in the market. They know each other. They transact, right? But in capital markets, you find these brokers play a role, and they have established desks to assist financial market transactions. You see these possibilities in the capital market. Then the role of money market is often liquidity facilitation. You probably see your liquid assets either get reduced and you wanted to inject some liquidity arrangements. Central banks often does in the money market in terms of liquidity management arrangements. They inject liquidity by buying financial assets from the market. So when they buy, they supply money, right? So then the liquidity in the market increases. When they sell, they absorb money. So the liquidity in the market reduces. Okay, so often what happened in the money markets is the liquidity adjustments. And the institutions also who play a role in a money market, not necessarily wanted to part their assets. They want their assets to be maintained in their books, but temporarily they want some liquidity facility. So they could come to the money market and pledge those assets and borrow. If they don't have space within so-called call money I was mentioning, you don't need to pledge anything, they can borrow. So there are various facilities. Central banks also provide these facilities. We will get to know all that as we move on. Okay. Then you see in the capital market, putting capital to work, the role is more long-term growth-based, as I was mentioning. Okay. Then you see this facilitate in terms of securing assets and productive employment of resources in the economy. You, me, everybody wants us to work and establish a career. You probably look at capital market based financial transactions are the basis facilitating such, right? In the money market, probably existing employment, existing working sources would have some liquidity facilitation and they work, right? So that would help them to manage the existing circumstances, expansion, new ventures, new capital investments, all comes with capital market. That's the role capital market play. And the relation with central bank of the money market is very close and direct. Okay, as I was mentioning, the central banks often come and play a role in absorbing and injecting liquidity. And they absorb through various modes, inject through various modes. We will be learning those stuff. And then you see capital market, the central bank makes the influence. They do the influence through interest rates direction, monetary policy, forward-looking announcements, and also even through short-term financial assets behavior and things like that. They influence, but relatively low in terms of close and direct engagement they have in money markets, right? So the market regulation in the money market, a very serious regulation, because these are the institutions. They are the ones who do the transactions, and their influence is very, very sharp in terms of how the immediate market behavior is concerned. So the financial institutions, banks, non-bank financial institutions, primary dealers, right, brokers, money exchanges, all play a role here and being regulated by respective regulatory agencies. And in the capital market, yes, still the regulations are there. Securities and Exchange Commission is there, right? Stock exchanges are there. Central banks are there, right? Insurance regulator is there, and even financial ombudsmans, they may be there. But compared to the money market regulations that you probably see, it is reasonably not that strict to great extent, because they have spaces to adjust their possibilities, because they have a longer duration, right? So you don't need to immediately do this and that like money market regulations are concerned. So these are the features that you come across. And then few money market instruments. You don't need to remember the numbers here, but you can see in US money markets, you probably see it's treasury bills, as I was mentioning, it's dominating. Then you see CDs, certificates of deposits, then the commercial papers, and Fed funds and security repurchase. These are the central bank facilities, federal funds and security repurchase. The Central Bank of US is Federal Reserve. So the Federal Reserve funds and security repurchase, that means temporarily a security is being pledged with the Federal Reserve, and they have drawn money for their liquidity purposes. And if you look at capital market, you see again stocks, bonds, and US government papers, and government agencies, municipal bonds, right? And also state and local government, that is also municipal bond. US government agency, that include municipal, plus there may be corporations, right? The institutions like NASA, even corporations which governs in terms of public parks and things like that, that comes in, right? So then of course you see other related private sector assets. These are trades, these are principal capital market assets you see in markets like US and other leading financial centers, but no different in terms of Sri Lanka or any other developing or emerging financial markets too. Then you see in internationalization of financial markets. We will come to this aspect also. Any questions before I move on? Right. You see these elements, and there are questions in terms of margin trading. Margin trading is, you see, you have assets, you have purchased on loan. For instance, say stocks, right? So you have purchased stocks. These stocks are valued, let's say 100 rupees now, and you have 1 million 100 rupees stocks in your portfolio, and you have loaned, let's say 50 million. Okay, so 1 million into 100 rupees stock is 100 million. You have 50 million. That means you are 50 million short, you have 50 million funded, right? So if you basically see your stock prices adjust, let's say to 150, 100 million has now moved to 150 million, because you have 1 million stock of 100 earlier, you had 50 million of your money being paid, 50 million being loaned. Now, because your price of stock has gone up by 150 rupees to 150, your portfolio, stock portfolio itself values 150, right? So at any moment of time, if somebody wants to sell that, they can sell it. They can sell it to 150. That particular agency can sell it 150, because you have done the transactions with that party, right? And that party has already given you a 50 million loan, because you have put only 50. The party has put only 50, another 50. So it's 100 matched already. But now, because of the price increase, right, the additional 50 rupee increase in the stock has contributed to additional 50 million asset in your portfolio, asset value in your portfolio. So anybody now sells, he can get 150 million, but how much you have loaned already, it's only 50 million. So the party who transacted, if you are not paying, right, he can cover that 50 million from whatever the kind of amount that he has loaned, and keep a particular percentage for transactions related and pay off the balance. So if still you are taking home close to 95 million because prices have gone up to 150. But if prices have reduced, you have originally seen it's 100, but prices have reduced to 90. So you have already 50 million loan amount is there, right? You have invested 50 million, but absolute value of your investment now is 90 million because prices have reduced to 90. So effectively, the original investment, 50 million being taken out of the equation, balance is only 40. So somebody has to now bring in additional 10 into the equation. If not, what happens is, if the transaction being executed at that point, you will lose 10 million. The broker or the stock manager would keep that 50 million with him and pay you only the 50. But if the prices continue to reduce and comes to 50, you don't have any assets. So only 50 million now left is that particular institution who loaned you. So he would probably do the transaction and clear it off unless you bring in new money. You have to then, you can't just keep quiet. You have to take money and adjust your account immediately, right? You have to pay off part of its loan. So that's a margin call because of the margins being established 50-50 or 60-40. That depends on the contract that you are entering. So based on assets valuation changes, amounts that you loan, amounts you invest, adjust. Based on that, the parties who transaction related, parties who transact with you would call you to adjust new amounts or pay you new amounts because of the changes in value. These are margin trades. That happens in financial assets. But there are various ways of other arrangements also come into play when it comes to margin trades. But you don't need to worry too much about the way margin trade, derivative trades happens. Only a basic understanding is enough, because we are not going to get into those stuff. Those are portfolio management, portfolio theory based investment analysis kind of studies. So we are not getting into that side of the equation. But if you are interested in, yes, very good area. You can learn and you can master some of these concepts. Any further questions? Right. So you see, similarly, internationalization of financial markets. Okay. So you see, financial markets are no longer homebound or domestic in today's context. It is not like you can basically transact with your neighbor and your kind of a trading outlook in the particular area. No, it is gone beyond that. Not only the country itself, but beyond the borders. And there is no way today you can talk about any financial market. Even in the case of North Korea, you probably see they have linkages with the rest of the world, at least in terms of commodities being exchanged across the borders, right? So you see this internationalization, and the financial markets are particularly across the globe is internationalized and integrated. You can't find a financial market that exists in terms of only looking its boundaries and transact. No. The institutions, assets, investors are widespread. And this also matters when it comes to saving investment gaps. Almost all the countries experience at different times in their history. There are countries who are always having surplus savings. There are countries who are always having surplus deficits. But most of the countries have both in terms of their history. But in recent times, most of the developing countries having a saving investment gap. Saving is not sufficient to meet their investment requirement. So then they have to meet their financial assets or the required additional savings, capital assets, whatever, from the markets outside their peripheries. So you naturally requires internationalization. And not only that, when it comes to assets and institution, today you cannot have your home-based regulations, home-based asset definitions, home-based rules and regulations. No, you have to standardize your rules and regulations in line with international best standards of practices. And then you see other elements come into play. Accounting standards will come into play, auditing standards will come into play, infrastructure standards will come into play. You can't have exchange being established in terms of so-called open shouting. Like you have the auctions where still you probably find some of these the customarily the markets do, but generally the markets are now mostly electronic, right? You don't need to physically present. You can be anywhere in the world, but you can get into the market in terms of access arrangements, and you can do the transactions. And because of this reason, internationalization has become the buzzword in financial markets in today's context. So even during this pandemic period, you probably see the markets could not keep themselves isolated. Physically, yes, you can't move around. You can't have links that you usually have because of virus and other related pandemic concerns. But markets are interlinked. Markets are working. Markets require to work. Otherwise, you probably be not in a position to have even the vaccines being availed across the countries who doesn't produce. Right? So you see the importance, and then you see the IMF, World Bank, Asian Development Bank, a number of other agencies, and even now the regional arrangements like Eurozone. Okay, then the discussions of Asian arrangements, right? So there are various ways, even SARC for that matter. So this internationalization is there. So you have to work with this internationalization. So when it comes to internationalization, there are certain concepts which is very, very important to know. You want to know first foreign bonds. Okay, so foreign bond is nothing but selling of financial assets, bonds in a foreign country. And interestingly, please remember, denominated in that foreign country's currency. If you are selling Sri Lankan bonds in India and denominated in Indian rupee, it is a foreign bond. If Sri Lanka is selling its bonds in UK and denominated in sterling pounds, it is a foreign bond. Foreign bond is you sell your financial assets in a foreign country. And interestingly, the bond is denominated in that foreign country's currency. That is a foreign bond. But then there's a slight difference when it comes to Euro bonds. It is not sold in Eurozone. No, it's not the case. It's sold in Eurozone as well as in other parts of the world. But in the meaning of Eurobond is, the bond is sold and denominated in a currency other than that of the country in which it is sold. For instance, we sell, Sri Lanka sells US dollar denominated international sovereign bonds. US dollar denominated international sovereign bonds. We don't sell them in US, but we sell everywhere else in the world. Asia, Middle East, Europe, yes. So it is a Euro bond. If you are selling, Sri Lanka is selling Aussie dollar denominated bonds, it's been not sold in Australia, but elsewhere, everywhere else, it is a Eurobond. So every ISP, International Sovereign Bond, the government of Sri Lanka has raised is denominated in US dollar. And this being traded now in the international financial markets. Outstanding volume of international sovereign bond to date is $14.05 billion. Right? So you see this Eurobond volumes. So this bond is issued as a Eurobond. So it's denominated in US dollar and trade and issued, and the currency of denomination is other than the currency of denomination of this bond, US dollar. We are not selling this in US. If I go and sell this in US and denominated in a US, it's become a foreign bond. Okay, so the difference between foreign bond and the Euro bond is very, very subtle, but requires to be understood. Foreign bond is sold in a foreign country, offshore, outside Sri Lanka's shore. That's the boundary of the country, right? And denominated in that country's currency. That's a foreign. Euro, in euro, we sell. In sterling pound, we sell in UK. In US dollar, we sell in US. Then it's a foreign bond. But we have not done any of those yet. But we have done Euro bonds. We were denominating all our ISBs in US dollar and sold in markets other than US. Okay? Hope you understood that point. Any questions? Right. So you see the difference between foreign bond and Euro bond. Then you see Euro currencies. Do you mean to say Euro currencies are the Euro? No, no. Okay, even Sri Lankan rupees, if somebody has deposited outside Sri Lanka in a foreign bank, it's a Euro currency for that country. Okay, so it is foreign currencies. Euro currencies mean foreign currencies deposited in banks outside the home country. So most popular, most common Euro currency is US dollar. Because everybody, even Sri Lankans, deposits their NRFC and other foreign inflows in US dollar in Sri Lankan banks. As long as US dollar has been deposited outside US, it's a Euro currency. Okay, in a way, it's a foreign currency. So even in India, if Indian rupee has been deposited outside India, you go to different parts of the world, people openly trade Indian rupees. I believe most of you are familiar with Singapore. You go to Singapore, you probably find even Sri Lankan rupees being traded. But in Middle East, very commonly they use Indian rupee in different places. And in countries like Nepal, Bhutan, Bangladesh, the border close to India, they trade a lot of Indian rupees. And the banks takes deposits in Indian rupees. So it's a Euro currency. Okay, so when it comes to Euro currency, it's been easy to define US dollar because Euro currencies, they call it easily as Euro dollars because US dollars denominated, US dollars deposited, it's not denominated, deposited in foreign bank outside US or in foreign branches of US banks. You have Citibanks in Colombo, right? You have other US banks, JP Morgan, whatever you call it. Okay, so those banks exist everywhere and they hold US dollar deposits. So it's a Euro dollar in their books because those branches are not in US but outside US. and facilitating US dollar deposits. And you have to understand what is a euro currency on that basis. Then you see, when it comes to internationalization of financial markets, world stock markets. Okay, so this stock markets is everywhere, global stock markets. You list your assets, and even Sri Lankan companies, they have listed in foreign stock markets, right? So that gives not only the attention and their presence in those markets, but also in terms of raising required resources to expand their business activities. So the internationalization facilitate them to bring in resources at reasonable cost. You might not have that same resources available in your domestic market. Okay, so this is a very interesting aspect. Then you see, we talked about internationalization of financial markets. This slide repeats, so you don't need to worry about that. So then you'll see, to some extent, these internationalization cannot be avoided and effectively benefiting all the markets in today's context and making it interlinked with each other in terms of its financial operations. And then you see the institution, financial intermediaries. Intermediaries are the parties who sits between borrower and a saver, or facilitating a transactions in terms of required arrangements. So you find, when it comes to functions of these financial intermediaries, direct finance, you see, you yourself go to the market and raise your funds. Indirect finance is, it's not you, but basically a financial intermediary funds your requirement, and he goes to the market and raises your requirements on behalf of you and bring and give it to you. So he's the one who lends to you, Bank A. But Bank A got resources from, right, person A, person B, person C, person X, institution Y, institution Z. I mean, he pools all savers, and he has, or from his own investments. So it's the intermediary who is responsible in terms of a contract you enter with. Often you and me, individuals and small timers, do not have a requirement of big volumes. And also we don't have so-called financial acumen to kind of do all those transaction documents, legal requirements, listing requirement, all kind of things, because we do a one-off kind of transaction. We go to financial intermediaries and obtain a loan, a facility. So it's an indirect finance. But interestingly, this indirect finance deals with so-called asymmetric information problems in financial markets. Please remember, one of the very, very important concepts of all what you will study all throughout is this asymmetry of information. Parties to the transaction do not process equal amount of information. Asymmetry. Some might have more, some might have less. Or even if you have equal amount, your capability to understand those information is not equal. It's like you are an accountant, you have much more clarity in terms of looking at the financial statements. I'm not an accountant, I'm an economist. I would not necessarily have that much of an understanding of the financial statement analysis. But when it comes to economic consideration, I might have a capability of looking at the prospects and the risks and the challenges of this, and also intrinsic value of the assets of those agencies, right? And many other things, opportunity cost, that this much clearer than the accountant who will have the same information. It's like you go to a medical expert and he knows by looking at your test report what problems that you have. Even if I have that, I would not necessarily able to kind of even read it, the prescription, what they have prescribed. So not only the asymmetry, not available equal amount of information, but being available, not able to kind of, review and clarify to the extent required. So one of the very, very important elements of all what you will learn all throughout is the asymmetric information problem in financial markets. So this asymmetric information problem exists in financial markets, create a very important role for financial intermediaries. The financial intermediaries come and try to reduce the possibility of this asymmetry. It is like barter trade. Somebody, a fisherman, he has fish. He wants to buy a motor vehicle. How much fish he has to carry and give it to the person who produced motor vehicle? He himself has to carry from the seashore to the central hills where the car manufacturing plant is there. By the time he carry all this, fish would become something else. Nobody can eat. You can't transact. Even if you are buying the skeleton of the fish for some other purposes, the price that you can get is totally different. So the buyer's requirement and seller's requirements are not matching. So financial intermediary exists. So he would, in the middle, he would buy fish, and then he knows who wants fish, and then he gives some of tokens to this particular fisherman. So that token is valid, and he can go and exchange. This is the role money is playing in financial markets. Today, electronic money is playing to great extent. So the asymmetry is something makes a lot of differences in terms of financial transactions being looked at, but then the role of financial intermediaries to reduce this asymmetry deals a lot of benefits in terms of financial markets transactions. So in terms of this asymmetry, there are things happens before the transaction and after the transaction. Before the transaction, so-called adverse selection, wrong or not right selection. Okay, so they probably look at it, adverse selection problem. So the financial intermediary would look at the investor who wants to borrow from them in terms of his proposal, his credibility, and now with other credit bureau information, other details of the party, whether he carries a goodwill, many other details. And try to avoid selecting the wrong borrower or risky borrower. The borrower would first say, I'm just buying a motor vehicle for my personal use, but effectively he intend to use that motor vehicle for transporting heavy goods or for the use of, let's say, racing. If you would have mentioned that, the loan values would be slightly different. So that's why the financial intermediary tried to reduce the adverse selection probabilities by gathering information about potential borrowers. They would look at established databases like CRIB, other financial arrangements that he has already taken, whether he has not honored, a lot of details. So these are very interesting aspects to deal with asymmetry. So before the transaction, the probability of selecting a wrong party, which is known as adverse selection, is a very important concept. So the financial intermediaries try to reduce the probability of adverse selection by gathering information. And because of this probability, still the pricing would be factoring a certain element of risk. They would lend you, but the interest rate that they would charge still to keep a certain portion of your loan in terms of the probable risks that they are carrying, although they gathered some information. It's like you best know your health. You go and try to kind of arrange a medical insurance, right? So you might say, I will go and have my family doctors, but they would say, no, you have to go to the doctors registered under that financial intermediary or insurance company. So they have little more trust in that agency. And every little details of your health would be looked at by those agencies. But still, you know your health much more realistically than the health experts who examine you. So there's a probability that you still hide in something. So to avoid that adverse selection, the premiums that they charge would still carry a certain portion that to factor that risk element that they discussed. Okay, so that's the one aspect of asymmetry, adverse selection. That happens before the transaction. Then you see after the transaction. Any question? There's another question in terms of whether the asymmetry existed in Sri Lanka's bond scam, right? So the great extent the market participants would get general information in equal information in terms of what's the financing volumes, what the arrangement in terms of financing and all kind of things. But there may be possibilities. But then, of course, some information in terms of changing the goalpost after the game started. That is not necessarily related to asymmetry, but maybe a decision not in line with the established processes. So that may be one reason one could have benefited in terms of the arrangements. But that's kind of, you can still link with asymmetry, whether the asymmetry existed or not in terms of the details publicly available now, right? So you see this type of elements in financial markets. But interestingly, when it comes to asymmetry, you have so-called adverse selection that happens before the transaction. But another aspect that is after the transaction, the moral hazard behavior, right? So the borrower or the people become complacent when they know there's a good father. He will protect you. You become complacent in driving when you know that your vehicle has a full insurance. If anything happens, you will claim through full insurance. But if it is a third party, you would be little more concerned. On top of that, if your vehicle is office provided or maintained by office, in comparison to your vehicle being maintained by you yourself from your own resources, or the vehicle owned by your parents, father would be very careful. He would not necessarily even encourage you to take and go without him, right? Because they simply see the moral hazard behavior. The moral hazard happens once you see that type of a possibility. You tend to take light in terms of the contractual obligations. Okay, and also the probability that the borrower will not engage in activities, right, in line with his original contract. He would take excessive risk and would not necessarily be worried in terms of paying back, because if anything happens and you see it's been the pledge for the loan, the agency or the financial intermediary can take the vehicle back. So you probably carefree use of that particular motor vehicle, and you become a little more careless in terms of medical facilities if your medical facilities been extended by your organization or you have an insurance. And probably you see in terms of the health bills, health checkups, dental facilitations, people try to take towards latter part of the year very frequently if you have not used up to that point, because you can't carry this to the next financial year. Even the holidays, you have vacation, but that vacation has to be utilized, and you find you don't necessarily require the vacation for the remainder of this December and finish the financial year, but still, because it's available, you take. This is moral hazard. You take excessive out of the facilitation. So your behavior is different. So the financial intermediaries are mindful of these probabilities. So adverse selection, moral hazard are part and parcel of asymmetries exist in financial markets. The financial intermediaries, through either gathering information and other arrangements in today's context, or signing contracts with restrictive covenants, restrictive contents in your agreements. If you not explained anything of your medical insurance and your death, or for that matter, anything happens to you on that basis, what you have not explained, you are not eligible to have the insurance cover. Your dependents also would not get it. So it's better that you reveal everything. So these are elements which is very important in today's context in financial markets. They look at these things very seriously, and financial intermediaries play a very important role in terms of having this facility. And then, of course, another very important function of so-called financial intermediaries in terms of indirect finance is they allow small investors the benefit of the financial market, both borrowers and savers. As I was mentioning, small timers would not have that much of resources, that much of capability, the know-how, expertise to go behind and figure it out, all the required asymmetries being addressed. Very difficult. Even financial intermediaries would not be able to address all the asymmetries. They still have some asymmetry. For that, they adjust the pricing. So the small timers make use of that financial intermediaries' expertise, and on that basis, get the financial market a benefit into their transactions requirement. So that's a very, very important function of financial intermediation in the indirect finance sense. Direct finance still possible, but small timers would find it economies of scale of direct finance is not right. Right? Still you can have it, but probably bigger volume transactions, institutional transactions would be really beneficial in terms of direct finance than indirect finance. But indirect finance much more suitable in terms of small timers, But small timers, if you wanted to see a big volume being financed through direct arrangements, there is no restriction. So if he has a arrangement and possibility, that's good, because he can raise funds much competitively. But then your requirement in terms of regulations, market practices, rules, that's there. But these are the elements that you have to kind of, get hold of in terms of financial markets in today's context. And there's another element, as we already see, one of the biggest concern of financial markets is the asymmetry, right? So the regulation that you see in financial market is trying, and the purpose of regulation is to bring in orderliness and also to increase the information available in the financial markets, thereby reducing the possibilities of asymmetry. Asymmetric information is not equal amount of information, equal level of information. And even to the extent the available information being facilitated by regulation in terms of minimum standards of information disclosure. The financial intermediaries and other related agencies and transactions to parties require to reveal at least a minimum requirement in terms of standard established in financial markets, and the regulations would really strict on these elements. So thereby, regulations would facilitate to increase the information available in the financial markets and thereby to the investors. And through this information dissemination arrangements, the regulations try to reduce the adverse selection and the probability of moral hazard behavior. Right? They try to kind of, help to understand. What you simply see in terms of referrals. If you are trying to get into an employment, referrals. Why the referrals? That is to kind of get a background check and even police reports from your closest police station. That's to know certain details, right? So these are part and parcel of the established systems. So the regulations would facilitate the availability of information in the market and thereby reducing the probabilities of adverse selection and moral hazards. And from another perspective, in securities trading, that may reduce so-called insider trading. Any information which has a financial benefit would be publicly known to the market and not being kept for the consumption of selected few and they acting upon it. The board of directors, senior employers, executives of organizations would have details of new ventures, new possibilities of expansion and things like that. For instance, you probably seen few days ago, the Browns, through its LLC, signed an agreement with China Harbor Engineering Corporation to have the financial city construction arrangements for the initial phase 1 and initial phase 2. The investments values are up to $1 billion, but coming in 2 tranches. And it might be invested across different time horizons. But this information is really valuable. right? As soon as that information is available, that means everyone else in the market, investors would know if you have a public announcement requirement for the LOLC or the Browns Group in terms of their listing in the stock exchange. That's there. But this information was available with the directors and senior executives because they were dealing with this. But if they have made use of that information to transact prior to the information become public and people start buying that asset, stock of that company, when everybody start buying, the prices increase. So they would have come and purchase in advance at a lower price, and they can sell at high price and get the profit. If anything like that happens, it's an insider trading. You have to prove, you have to have a process to go through. But these are the possibilities. But what simply is there is such arrangements through regulations would facilitate at least minimum standards of information publicly available for the market in terms of the new projects you enter, changes to the senior management, even if you see changes to chairmans and deputy chairmans of top commercial banks. In advance, they had to announce. The arrangement is they will take over from a future date. But they were stepping down by this time is known to the market about 6 months ago. You had to make that announcement. Who would succeed? Who would take over? The prospective candidates are this. That's known to the market because the people also matters at very senior levels, senior positions. Based on their engagement, the financial intermediary and the markets get the credibility. So the regulations facilitate the information available in the form of what I was explaining to you all. Any questions? Right. So further, the regulation also ensure the soundness of financial intermediaries. To become a financial intermediary, you need to have certain standards of requirements in terms of capital, in terms of systems, in terms of qualifications and the requirements of senior management, diversity of shareholder ownership. One cannot have the entire financial intermediary as his own. No, then it's a own business, right? So there are various arrangements that make sure the financial intermediary's soundness in terms of regulation established. So these regulations either come through legislations passed by the parliaments or the powers vested in terms of those regulations and issued as directions or regulations by the financial regulators. The central bank issued directions and regulations periodically with respect to the financial intermediaries because the legislations provide that the facility. So then you see the soundness of financial intermediaries being looked at in terms of restrictions on entry. It's not like just a boutique down the street that's been established in terms of financial intermediaries. You are dealing with the deposits of general public. Then somebody can mislead the general public and have all the money and run away. That happens. Unauthorized deposit taking, that happens in and off. So the greediness of people also helping them to kind of benefit from such probabilities. When somebody says that I'll provide you a very high interest rates, they go behind that. They have to be mindful of the fact that, okay, to provide me this much of interest rate, he should be investing that in an environment or in an investment that yields much higher interest return than that. High risky investment probability. They were not bothered to get into those details, so they get misled. That's one aspect. But to make sure the financial intermediation sitting on a sound footing, there's a restriction in terms of entry. This restriction could come in minimum capital requirement, for instance, now 5 billion. This would increase in terms of risk-weighted capital adequacy requirements. RCA, risk-weighted capital adequacy requirements going forward. When you have more risky assets in your portfolio, your capital requirement increases proportionately with the risk of your portfolio. But for the entrance, to get the license, you require at least minimum. And this minimum capital requirement would not be by a single individual. Individual ownership limits also there. Single party cannot hold, let's say 10%. With special approvals, yes, there's a possibility that could be facilitated, but that required to be gradually reduced over a period of time, either by increasing the capital base, bringing in new capital by others, or the single owner reducing his stake by selling it off in the market. There are various ways of looking at this. Then the infrastructure. You require to have a treasury management system. You require to have a facilitation in terms of software and infrastructure to link up with rest of the market participants in terms of the electronic fund transfer arrangements. You probably see RTGS, then of course the electronic securities arrangements, Lanka Seco, where the government securities being maintained, and also in terms of ATM arrangements in today's context. Otherwise, you can have a business without ATM, but your popularity and other related details would not compete enough with your competitors. Not only that, people who is managing, whether the party who is managing is fit and proper. It doesn't mean he's physically fit and proper in shape. That's not what it means. It means in terms of his creditworthiness and his career. If he's already blacklisted, he cannot be a senior position, cannot hold a senior position in a financial intermediary. His track record is not right. So you see the restrictions. And if it is like an entity which tries to work in only in city centers, not necessarily going into the peripheries and promoting small and medium scale financial intermediation, there may be other restrictions also coming. So various forms of intermediary based evaluations would be carried out, and this is known as a chartering process. So the restrictions on entry in terms of capital, in terms of resources, in terms of systems, in terms of infrastructure, right, all being looked at by the intermediaries in terms of requirements established by the regulator, and this would be reviewed periodically. It's not one-off, although you give the license and some after a kind of a continuous periods, you probably see these being reviewed by the regulators. Any question? Right. So then, of course, you see disclosure of information. As I was mentioning, regulators would keep a very close eye in terms of the requirement of disclosing information. If you are a listed company, you have a disclosure requirements in terms of a listing in the stock exchange or Securities and Exchange Commission would follow up. Then you see your audited accounts. You have to have publicly available audited accounts certified by a auditor, licensed auditor, within a certain duration, let's say 3 months after the end of a financial year. Unaudited within 1 month after a financial year. As I was mentioning, disclosing changes to the senior management. Who would be taking over the chairmanship, CEO, head of finance, head of treasury, the directors, all details, and even new projects. This needs to be publicly disclosed to avoid possibilities of, as I said, there's a lot of ways of carrying out insider trading there. Then also you see in terms of restriction on assets and activities. Okay, you have restrictions in terms of if you are a financial intermediary, you yourself owning controlling interest of another financial intermediary, restricted, because you can act as a cartel. You can collate and create a market, but it's not necessarily market. It is between you and your own controlled subsidiary. You can have subsidiaries, but not necessarily in the same line of business, but facilitative business. For instance, if you are a financial intermediary, you can have a stock brokering firm. That's to facilitate transactions, right? So there are various ways of looking at it. And also in terms of assets that you own, you cannot have all the loans in one type of loan category. For instance, let's say agriculture. If there's a collapse in terms of a drought, in terms of a flood, natural disaster, if you have lent everything to agriculture, all your portfolio become non-performing, bad loans. How are you going to survive? How are you going to honor your depositors? So there's limitation, restrictions, only 20% of your portfolio in agriculture loans. You bringing those elements in terms of regulations to make sure your financial intermediary is in a sound footing. It's not to kind of, limit your competitive edge. You can become a very competitive, you can expand your business, you can go on attracting new businesses and profits, but higher the profits, you also taking higher risks. So to balance these risks in terms of overall macro conditions, market conditions, you require to bring in certain type of regulations, and this been established all around the world in terms of having assets and activities being monitored very carefully by regulators on a continuous basis. Then you see you've been regulated to great extent to have some deposit insurance arrangement. This is to mainly avoid bank runs. So if a bank is having difficulties, and if the depositors come to know that, they will queue up in front of the bank to withdraw their all deposits at once. When everybody is lining up, your assets, liquid assets that you have is not enough to meet the demand of these depositors. Then what happens is you have to sell your assets, and this becomes fire sale. When your circumstance is such that you are desperate to sell, you would not get the right price. And even the market, once they realize that you are in a difficulty, they would make use of your situation to not to quote you the right price. So you are forced to sell at a loss, and that would create a lot of difficulties in terms of the asset returns and assets prices that you can get. So to make sure that such possibilities be minimized all around the world, now you see a concept called deposit insurance. So up to certain amount, up to let's say 1,600,000, your deposits is guaranteed. So the depositors who are below that amount, even if there is a problem like that, would not worry to come and withdraw, because they know if anything happens, their deposits are insured, and the deposit insurance arrangement would pay you the deposit insurance. So they are not necessarily running and queuing behind those financial intermediaries. But yes, when you have a deposit insurance, you have to pay a premium. For insurance, you have to pay a premium. So that premium means what you pay out to your depositors in terms of returns, a part of that goes to that deposit insurance arrangement. Okay, so you see this deposit insurance and its importance in today's concept. And then competition related limits in terms of past arrangements. Today, of course, you don't see limits in terms of competitions to establish branches and restriction on interest rates, simply because you see there are various ways in which difficult financial intermediaries try to motivate new deposits, new assets into your organization by paying higher interest. And as I was mentioning, if somebody is paying higher interest, possibility that he get a higher return also need to be verified. If not, you are blindly depositing. It's a responsibility. For that, you require to have so-called financial literacy, financial understanding. That's why you all also study these subjects. General public would not necessarily have, but you have to educate them, right? So there are various ways of then misguiding the people by providing gifts, providing travel, providing fun events, all kind of lotteries and things like that. But to great extent, those been restricted now, right? In the past, even the branching, even in foreign countries, they don't let branches being established in different part of the country unless the regulator bring in required standards to be honored by these financial intermediaries. But today, you wanted to have more branches, that means your cost of operations increases. So the financial intermediaries, they themselves mindful, and you don't create branches for the whims and fancies of politicians. He wants to have a branch in his constituency. You don't need to. It is purpose-based. Whether you have enough business opportunities there, whether you have enough clientele to serve, whether you have enough resources to manage. There are various things to be looked at. And the regulations would facilitate these. And through these regulations, you probably see financial intermediation being further enhanced to act with soundness. And also, as we were discussing in previous slide, you've seen that these regulations facilitate a lot in terms of establishing and reducing the asymmetry. And these are very important concepts. And these concepts that we discussed is very important, and we will follow at different points in discussions all throughout this program. Any questions before I move on to the next heading that we wanted to discuss? Any questions? And probably we will not have classes next week. I think it's 26th. We would not have the lectures, so we would probably start the class again in 2021. Right? So next week we will not have classes. We will see the lectures starting again in first week of January 2021. Any questions on what we discussed up to now? Because this financial markets and elements that we discussed is repeating in various ways all throughout this program, because the concepts that we touched upon is very important, and very important for you all to follow up the elements that we will discuss in other parts of the course program. Right. Appears that you don't have questions on what we have discussed up to now. So we'll start the topic of interest rates. One of the very important areas of discussion in this program. I will basically introduce this area at today's discussion, and we will get into greater details as we move on next lecture, that probably in the first week of January. So you see these interest rates, and this interest rate remain one of the mostly watched, if not very closely watched, variables in any economy. Whether it is Sri Lanka, whether it is India, Singapore, Australia, or US, the interest rate would be followed very closely by market participants. Not only the participants in your economy, but also elsewhere. Because the interest rates in your economy would give them a lot of information and the possibility of fund flows across the globe in terms of comparative probabilities of having a different rates of return for their investments. And you probably see the interest rate movements are reported almost every day, and not necessarily on a daily basis, but on hourly, if not more frequent basis in financial media. And this is very important because this affects everyday lives and have important consequences for the health of the economy. If the interest rates are continuously increasing, the probability that that would slow down the further expansion of investments. Or if interest rates started increasing from a continuous decline point, it may create a kind of a push for investments, because people who wanted to expand their businesses would think, oh, this is the right time, we should quickly take advantage before interest rates become higher, increase. So we'll try to have facilities and expand our business activities. So they might push for it. Okay. And the interest rates, again, would make your decisions, whether you save today or consume. So if you think that the interest rates are very attractive, so you would probably save little more than what you used to. And see, that would help you to have a higher return from your investments. Or whether you might think, oh, interest rates are now competitive, why not I would go for a house? I will expand my existing residence. Right? So all these decisions, investments in bonds or in saving funds, okay, and also these interest rates contributes to economic decisions of not only household and businesses, but also in terms of activities of governments and also the corporations. And you might think of expansion, new factories and all other things, but also the governments would look at in terms of the budgetary impact that the interest rates would carry in its obligations, because they probably have already borrowed a lot of money. I mean, the countries who are having debt to GDP levels, very high debt to GDP levels, Sri Lanka also one of the countries who has difficulties if the interest rates continue to rise. Not only in terms of meeting the obligations, but also accessing financial assets. Okay. So we would see these aspects as we move on. And before getting into kind of linking up this with yield to maturity and related concepts, I would happy to stop at this point, because this has links to continuously the other elements that we would be discussing in this section. So I would stop at this point and leave open for any questions that you have in terms of what you wanted to clarify. If not, I'll stop at this point. And as I said, we will not have the class next week. We would see the class hopefully during the first week of January. So I wish all of you a Merry Christmas, if anybody is celebrating Christmas. If not, seasonal greetings and a very happy New Year 2021. And we will see, we'll be meeting, for discussions in early part of next year. Stay safe.